Joining us now, economist Chuck Lieberman, Chief Investment Strategist, Advisors Capital. And Chuck, we don't really know what stocks are focusing on, do we? I mean, on a day with no volume, when the movement is really very little, you can't tell what's really moving the markets. What we can tell is that G8 leaders are trying to pump up our opinion of the global economy, which is what you'd expect them to do, right?
Precisely right.
Doesn't mean that it's true.
Well, it actually happens to be true. It's not terribly insightful on their part, but it does happen to be true. If you look at the U.S. economy, we're slowly but surely, and it's pretty irregularly, gathering momentum. If you look at job growth, for example, over the latest 3 months, we've added about 700,000 payroll jobs. That's significantly better than the 3 months before that.
Sure, even more, 760,000. But do you really expect that to continue? I mean, will we be adding jobs at more than 200,000 a month going forward?
Well, we may have a slight slowdown right now because of the consequences of what happened in Japan and the disruption to the production pipeline. All the measures of production.
The disintegration of Europe?
Well,
wait.
That's a stretch.
Let me go back to the economic news. Ken Paul-Carey sent this off to me this morning, and he talks about 3 of the regional manufacturing surveys released so far have shown unexpected, decidedly negative numbers. First quarter GDP was below expectations. You've got slower consumer spending, inventory buildup, core capital goods orders in decline.
Stop.
And you've got weekly jobless trending, continuing to trend above 400,000. So
now,
where's the good news?
Reread that list, and how many of those items are different measures of production? Almost every single one. GDP is a measure of production. Industrial production, a measure of production. Durable goods orders, which include shipments of products like cars, which are sales equal production, a measure of production. So the manufacturing sector has slowed down. Why? And the biggest part of the slowdown is in the auto sector. We know that. Why? Because of the disruption from supplies from parts from Japan.
So you're saying this is a soft patch and we're going to push through it?
Absolutely.
And you expect us to come out on the other side adding more than 200,000 jobs a month going forward? You think the economy really is going to pick up and strengthen, allowing us to make the kind of cuts that are sinking European economies?
The job gains that you talked about, that produces income. Households have the ability to spend. The rise in oil prices took some of that spending power away from households. Oil prices are now back down a bit. Gasoline prices are down 20-something cents in a couple of weeks. That puts consumer spending power back. And plus, if we continue to maintain job growth in the ballpark of 200,000, put all that together, consumers will be back buying.
What happens when QE2 goes away? We've talked about this ad nauseum this week, but understandably so. You take a look at a chart, Chuck, and you can see how the S&P 500 has moved as the Fed has increased its balance sheet. So what happens when we take that away?
Well, I think the Fed has moved, and the market did move in response. But the fact is, the market is moving in response to the improvement in the economic outlook. The Fed's action obviously improved the outlook. It gave more confidence that the Fed is committed to an economic recovery. I've said all along that there's one thing you can absolutely bet on here, which is that the Fed is committed to an economic recovery. It's been committed to a recovery since early 2009, and it is no matter what. And they will not, for example, hike rates. They will not tighten monetary policy until they're absolutely convinced that they've got a self-reinforcing expansion underway. And until that happens, any rises in rates are temporary. Any sell-offs in the equity market are temporary. They're buying opportunities. Look at the underlying profitability of companies at all-time highs. Profit margins are at highs.
So time to buy in your view,
Yes,
then?
absolutely.
Really?
Absolutely.
Why are the defensive stocks, though, then doing better than
because
other names?
They are the mirror image of what happens to the more cyclically sensitive parts of the economy. And as the economy decelerated, you have people running around suggesting that the economy is going to go off the edge of a cliff, QE3, QE4, 5. That's nonsense. It's absolute extrapolation of very, very short-term data. It ain't going to happen.
Let me ask you about housing. Surely you can't be optimistic about everything that's going on in this country. And as people, I talk to so many people who are looking to buy a house, and it's kind of a deflationary thing. They're like, I want to buy a house, but I'm going to wait till prices continue to fall because they know prices are going to keep falling.
Right. And as long as prices keep on going down, it's an encouragement to wait.
And interest rate stays, stays so low.
One of the reasons housing prices as measured keep on falling, though, is because they're not measured correctly. So, for example, the fraction of all home sales that are foreclosures, that has increased dramatically. Foreclosures typically sell for something like a 25% discount compared to everything else. So what's happened is, as we measure it, housing prices have declined, but in fact, the supply has gone away. Just this morning, I heard on Bloomberg Radio, so it's got to be true, that
You're right.
there was a real estate broker on saying that the rental vacancy rate in New York City is 1%. 1%. There is no vacancy. So population growth absorbs.
That's New York, though. Maybe that's.
That's correct. New York is an outlier. But the same data is true, the same trend is true across the country. We are investors in real estate investment trusts. There is not a single real estate investment trust that is experiencing a rise in vacancy. They're all reporting large increases in occupancy.
Okay.
None of them are cutting price. All of them are seeing better revenues.
Sounds like we got to look into REITs, too. Hey, Chuck, good stuff.
Fantastic.
Thank you so much.
Chuck Lieberman for Advisors Capital. Thank you so much.